All right. Who's
Good.
ready for down payment assistance education tonight? Um, just for everybody out there, I'm Mark Kozik. I am the owner, along with Curtis Russell, of Great Homes ATL. We are a brokerage firm here in Greater Atlanta. Really pride ourselves in education and giving everybody the ability to fulfill the American dream. And we like to have guests on our platforms to help you fulfill those dreams. So tonight we are, and I'm taping this on February 20th of 2025. Hard to believe, right, Mark?
Yeah, I know. Year's gone so fast.
Right, right. And February is a short month, but we wanted to first introduce our good lender referral here, Mark Scarratt. He's with Ameris Bank and has a lot of years of
More than I should say. Yeah.
in the industry. And we wanted to do this video for you guys because around this time of year, there is a release of federal funds from the federal, is it federal
Home Loan Bank,
bank?
Federal Home Loan Bank.
And it is launching on February 24th. So when we're taping this on the 20th, it'll be launching next Monday. So we wanted to do this video for all our platforms on social media, on our website to educate you guys on it. And we'll get into other programs outside of down payment assistance. But let's jump right into it. So, Mark, if you can just to introduce yourself, tell people like where you're based out of and a little bit about maybe Ameris Bank and before we get into the actual program.
Well, Ameris is a bank based out of Georgia, although we have Florida offices and up the East Coast. I work in the Cumming, Georgia branch, but I can basically help people anywhere because everything's basically done by the internet now. So it's not necessary that a client drive out to Cumming for us to do business. Um, a very good bank. I think we're the top residential lender in Georgia, at least from the latest that I saw. So I feel like we're doing a lot of things right. And I've been in the business for a number of years. It doesn't mean I know everything, but I've seen an awful lot of scenarios with potential home buyers that we were able to help.
Absolutely. And just to give you guys some context, we started Great Homes ATL officially as a brokerage firm in 2020, but we were a team before that when we started the actual Great Homes ATL brand around 2015. And we've been working with Mark probably now since about 2016, 17. Correct? It's crazy.
I think so, yeah. And I'm grateful to have the referrals and the
Oh,
confidence.
yeah, yeah. You know, what I love about Mark is that he really um, cares about the client. He really tries to educate you up front and try to make it not a scary, experience. And we'll talk a little bit about what you can expect from the actual process, but I'm sure people are really, really interested in this down payment assistance program. So let's jump right into it, Mark. If you want to talk about the first one, I think it was let's work off of the 15, then we'll go up to 17.5 and then the 20,000. So what's the one that's 15,000?
Well, there's basically three programs. There's the workforce housing, there's the community partners, and there's the first-time home buyer. Now, community partners is 15,000, and down payment is actually, I'm sorry, that one's the community partners is 20,000. And that one, you don't have to be a first-time home buyer as long as you're buying a primary residence.
So we're gonna
Um,
start,
th-
I want to start with the 20,000 and work our way down.
yeah, because I believe all of them. I think it used to be 15, but I believe let's see, okay, workforce housing is 15. Um, Let me finish community partners, and we'll talk about the workforce. Community partners is primarily for educators, retired or current law enforcement, healthcare workers, firefighters, first responders, also for vets or former active duty vets. So that's the program that you don't have to be a first-time home buyer. And it's basically 20,000 that you can use towards down payment or closing costs or a combination of them all. That one is at 80% of the FHA area media income. And that's a term you'll hear a lot.
Can
I've got
we
some
talk
examples.
I stop you right there. I just want to, for people that don't know some of these terms and, maybe are out of town or here locally, could you
Sure.
define what AMI is and kind of give an example of this, that range of 80% and give, you could go off of a number like as an example, $100,000. We know that 80% of that would be $80,000. So you could just talk a little bit about what AMI is and um, then we could get into about the households and what that makes up.
Sure. Well, there's really two types of area media income. There is the HUD or FHA, which you can use that for conventional or FHA or VA loans. And then there's the Fannie Mae or conventional. In this case, the Federal Home Loan Bank uses the HUD median income, or actually area media income. And I can give you some examples. One thing I looked at, we had talked about looking at different counties, but it's really the same for almost all counties. Fulton, DeKalb, Clayton, Gwinnett, Forsyth, they're all the same. The only county I saw that was a little bit lower was Hall County, but every other county that I checked. Now, the median income or the area median income is based on how many people that are in your household and how many people will be moving to the new home that you're buying. But just an example, the 80% of area median income right now for one person is $60,240. So for this particular program, you want to make that, that or just below 60,240, but it jumps up a good bit depending on the number of household members. Like, for instance, if there's three people in your household, and that includes children, it's 77,440. Or if you have four people in your home, it's 86,000. So it goes up a pretty good bit based on how many people will occupy the new house.
And let's talk about that because when we were talking offline, this is a little different than some other down payment assistance programs. We did the grant programs, which we'll talk about a little later.
Hmm.
Um, I want people to understand on this household. So let's run a couple of scenarios.
Sure.
Sounds like to me, it would definitely be somebody that maybe they have, a parent living with them that no longer works. If it is a couple that maybe has, like you said, two jobs, one spouse, another spouse, and they make, $40,000 each, it sounds like as long as maybe they have kids that don't earn income, that's a four-person household. So in that scenario, it sounds like they would pretty much come pretty close to that 80, would you say 82, 84,000?
Well, sure. I mean, if it was a husband and wife or a partner, and they, let's say they had two kids, that would count as a four-person household, and the limit on that is 86,000. So in your case, if they both made 40, that would be okay. They count income on anybody 18 or older. So, if you got a kid that's working a little part-time job that's 16 or something, they won't count that. But you have to be careful if you've got an 18 or 19-year-old and they're working at McDonald's, they're going to count that income. And the income they're looking at is all the people that will occupy the new house. It's not, if you've got four people in the house, a married couple and two kids, well, obviously all of them are going to occupy the house. If you had a situation where you had let's just say a grandparent or something that was going to live somewhere else, you wouldn't count that income towards their goal.
Okay. So this is very important. And when people hit us up. We're pretty big on Instagram and Facebook and Threads and YouTube. A lot of people will send us emails, DMs, and ask us, I'm looking for this price house, or how much can I qualify for this? This is the reason why it's really important to get in front of the lender, because there are various programs, and you could hear just from this program number one, not overwhelming stipulations, but there are stipulations that there's certain times people will hit us up and say, "Hey, do I qualify for this?" Well, as you see, there could potentially be $20,000 available to you. So, Mark, talk a little bit about, I'm going to just run a scenario by you, and just to give people some examples and how, what they should expect from the experience. So, what we've set up, guys, on our website, GreatHomesATL.com, we have a button that says Get Pre-Approved. And when you fill that out, it actually goes right to our lender contacts, our lender referrals, and Mark is one of the lenders on the top of our list. So he will get a copy as well. So what you should expect is now, pick up the phone when he calls, or if he leaves a voicemail, reach back out to him and put some time on the calendar to talk about things like this. So let's just run a scenario, like I said, let's use the example that I have a spouse and I make 40,000, they make 40,000, we have two kids. There's nobody else in the household. Mark, what are you going to do during that process? What is your process to gather the information? Because I want to make people clear that there is a difference, and what's really hurting the marketplace to me is when people go on Lending Tree or Bankrate or Rocket Mortgage and all these things, and they're just typing in basic, information, and you're not one-on-one dealing with especially a local bank like Ameris Bank. You really want to talk about the difference between a pre-qualification and a pre-approval, right?
Right.
So they used to be kind of intertwined. But Mark, I know you have a much more streamlined process to make it less stressful for people. So in this scenario, let's say it's Mark and Kim, we are reaching out to you to go for your pre-approval, and we make that 80,000. What documents are you going to be asking for?
Well, if we're talking about this federal home loan bank program, I'm always going to have a conversation with you, really anybody that made an application. But as good as this program is, you have to be careful of a few things. Like you mentioned, the two of you making 40 each. Now, Federal Home Loan Bank will look to see if you got a bonus. Even let's just say that you got a $5,000 bonus this year, even if it was a one time, they will add that to your income. So we have to, and that's not true of all down payment assistance programs, but this particular one, they're going to look for any income. If you had a parent that was giving you money per month, they will annualize that and put it in. So that's why it's important that I'm going to have a conversation with everybody about who's in your household, who's going to go into the new home, and any get you to think about any income that you've got that maybe you haven't thought of, because that's very important with FHLB loans.
So let's
And,
run down, because I think this trips a lot of people up, like you said, when they get bonuses and things like that. What documents would you be requesting from pay stubs, tax returns, child support, investment accounts, all that could be looked at as potential income?
well, we're going to get pay stubs, and pay stubs, if you've received a bonus, it's going to be on there. It's going to show year-to-date bonus. So they're going to look at that. Child support is typically by the divorce decree, so we're going to get a copy of a decree and see how much you're receiving. And certainly it's allowable income, but we got to be careful with this FHLB product that it doesn't put you over the category. So, whereas with some other types of loans, we might count that bonus if you don't have a 2 year history. But with FHLB, we have to be careful of that. It's a great benefit getting $20,000, but they're very serious about their income cap. That's probably the main thing with FHLB. You got to be very careful. So when we talk, maybe take out a bank statement and just look and see, is there any extra income coming in that maybe you forgot to mention?
Gotcha. Okay. And again, this one, guys, is called the Community Partners one. It's for first responders, educators, veterans, and more. So, I think we kind of know, unfortunately, we don't pay our first responders and our teachers, especially, and a lot of our veterans too, the pay scale that they really deserve. But I think, like Mark said, because of the 80%, you're looking at starting at the low end, Mark, you said around 67.
Yeah, for almost all counties, it's $60,240 for one person. But like I said, most people have more than one person in the family, especially if you have children. So it goes up a good bit. Like for a four-person household, it's 86,000. And
Right.
we're going to talk about another program that's, when we get to that, which allows more.
And why this is so big, and you kind of, I've been doing this for a lot of years. Mark, you've been doing this for a lot of years. Somebody that's probably today's day and age with interest rates and all kinds of things going on, making between for that household 60,000 to that 84,000 range. I mean, you're not talking about $500,000 houses here, guys. This is like a program to really get your foot in the door, and try to find you. My guess, Mark, would probably be these homes will probably, what would you say, 250 to 350 range, maybe at
Well, it depends on the number. Like, 86,000 for people would probably put you in the 350, perhaps as high as 400, depending on your debt. If it's a single person, I would agree with you. The 60,240 is going to put you in that 250 or below category.
And I want to emphasize this for you guys too. This is not to say, if you make more money than that, there's going to be various programs we'll talk about tonight. This is just strictly for people that, maybe have really thought home ownership was not going to be possible for them. So I just wanted to set like realistic price points and expectations for people, so that, when the pre-approval comes back to us, we know what to search for, what's reasonable for a certain area, and what we can get for you. Now, Mark, this is both for FHA conventional loans, both together.
Yeah, it's as far as the FHLB, goes off what the lender will approve. If we approve it, they're only concerned about their income cap. But the first of these FHLB loans was community partners, which is primarily dealing with people that are first responders and firefighters, teachers of that. In that particular product, you don't have to be a first time home buyer. You can be buying as long as you're buying a primary residence. So that's a distinction. Now, the next product is first time home buyer. Now it is 17,500. It has the same income caps that we just talked about, but it is for people that have not owned a home within the last 3 years, and that's open to anyone. So the main difference is with community partners, you need to have a particular career that fits into their mold. For the first time homebuyer product, it doesn't matter. You certainly don't have to be a first responder, a teacher, a police officer, or anything like that. So that product has the same qualifying, and they're going to look at household members, particularly that are occupying the new house. And it's a little less, it's 17.5. So these two programs, it's going to be easy to determine which one you would go with as to what type of profession you have.
Yeah. And, just some math, easy math for you guys. FHA is 3.5% down. Conventional for first time home buyers is 3% down.
Correct.
So, like, if we were just, I'm just got my calculator out here. If you did 3.5% of 300,000, that's $10,500. So, why this is so big, guys, is that means your down payment is taken care of as a first time home buyer. Like, that at that 300,000, that's 10,500. Now you still have about $7,000 still available to you. Mark, what else can you do with that money? Could you touch upon closing costs, rate buy downs, and how you could use those extra $7,500 in that scenario?
Well, it can go towards anything. It can go towards your closing costs, but keep in mind when you buy a home, you've got three things. You've got your down payment, your closing costs, and your escrows. And that's another thing a lot of folks don't know about. And escrows are not fees, they're just money that you have to set aside to pay the taxes and property taxes and the homeowner's insurance on the house. So let's say a client, does not have a lot of savings. They would more than likely use, say the 17.5 or the 20 to make their down payment and pay a big chunk of their closing costs. Now, a person that had some money that maybe could put their own 3% or 3.5 down could use that whole 17.5 or 20,000 to maybe do a 2-1 buy down or to probably take care of probably a permanent buy down to the rates. So if you've got your own 3 or 3.5, you can use the money for your closing cost and prepaids.
And that's really important, guys, because like those two scenarios, from the real estate agent perspective, I want to talk about earnest money. So when you get a contract in on a house, we go shopping for a house and you want to put in an offer, as an example, on this $300,000 house. Industry standard is pretty much like 1% of the sales price. So you would put about $3,000 earnest money. Now that money sits in the pot. It goes towards what we're talking about, down payment and closing costs. So if you've already put $3,000 into this pot in this scenario, and you've already got your $10,500, from your FHA 3.5% down, and your closing costs and your escrow accounts are pretty much about 3.5% on average, because that is historically how it's been. There's certain
That's
things,
a good estimate.
it's a pretty good estimate, when the market was really low and stuff like that. It's probably 3% now, depending on the county and property taxes. And we'll get into it a little bit later, homeowners insurance, which has been going up. It's a safer bet to be in that 3.5 to 4% range. So we're talking about 10,500, 3.5%. Your down payment's taken care of. Now you have 7,500 still to use, and you've already put $3,000 into this account, which is your earnest money. Well, that's pretty much adding up to about $10,000, right? The 7,500
Mm-hmm.
left over plus the 3,000. So there's a good chance in that scenario, buying a $300,000 house, that on the day of closing, you may get money back. You may break totally even and not have to bring anything to closing, or bring a very, very small amount. That's how the power of this program is really, really strong. Like Mark was talking about, I just want to take a pause here because we're throwing a lot of these terms out here when we talk about one rate buy down, 2-1 rate buy downs, and things like that. Mark, when we're taping this in February, interest rates have been hovering between like 6.5 to 7%, depending on the day, depending
Mm-hmm.
on inflation numbers coming out, unemployment numbers, all that kind of stuff. So talk about a scenario of how you could use potentially that 17,500 to, if the rate was in the market we're in about 6.5%, how you can use that money to do what's called a rate buy down, either a permanent or a temporary. Let's start with temporary and how that works.
Well, different clients are going to have different needs. There are going to be some clients that really need the down payment assistance to make their down payment for them. Maybe they've got $5,000 or $6,000 in the bank. In that case, and I'm always going to advise people of the best way to use the money. In that case, it may not be enough for a temporary buy down, but then you're going to have clients that have the money really without this money, they could still buy the house. They've got enough to put down the 3.5%. They've got enough money for closing costs or most of it. That's where you've got this extra 17 to possibly do a temporary rate buy down. Those are popular on new homes right now, but as long as it's paid by the seller, the builder, or through this program, you can take, let's just say that the going rate is 6.5. What they call a 2-1 buy down is where you start 2% below for the first year. So in that case, you would start at 4.5. The next year you would be at 5.5, and then The third year and through the rest of the loan, you would be at the 6.5. And that's going to be geared a lot towards people that already have the money for their down payment and other stuff. So because buy downs, depending on the price of the house, probably between 11, 12, $13,000. So if you're needing that money for your down payment and closing costs, you may not be able to do a 2-1 buy down. You might be able to do a permanent buy down, which is less money. A permanent buy down is when you pay points, and points are 1% of the loan amount. So,
That's an example of a $300,000 house. Could you give people an example of that?
well, let's say the loan, because it is based on the loan, not the sales price. So if it were a $300,000 loan, 1 point is $3,000 that you pay at closing to get a rate lower than what the going rate is. Or if you paid 2 points, that would buy the rate even lower. And in that case, that's a permanent buy down because that will be your rate for as long as you have the mortgage, or, up to 30 years.
And so in a scenario like that, say the interest rate is 6.5%. In this scenario, you've got like 17,500 and you decide to use it towards that because you already have your down payment, you already have your closing cost. How much do you think it would bring it down for a permanent, not 2-1 rate buy down,
Well,
but
that's a good bit because you're talking about, I mean, if 1 point is 3,000, then 3 points is 9,000. That's 4 points. I mean, that's going to buy the rate down into the fives, probably in the 5.75 range. So you could use it for that to do a large permanent buy down with the DPA money. And
that's
we'll talk a
about
little bit about it being stackable. Um, but that's just with the 17.5. I mean, that would buy quite a few points.
and what this means, guys, for you. So when you are paying a mortgage, right? You're paying a portion towards your principal to start paying that down. Your interest, which is what we're talking about with this, your interest rate, what's called private mortgage insurance, and that's on a loan when you have less than 20% down, or if you're VA, you don't have to do PMI. Medical professional loans, which we'll talk a little bit about because I'm really excited about that one. And there's a few other ones that don't have PMI as well, but that's part of your mortgage potentially as well. And we talked about the escrow, so homeowners insurance, which you could shop for every year, and property taxes. As your house goes up in value, obviously your property taxes will as well, or if there's higher, what they call
Sure.
millage rates in a city or county as well. So, you know, it could lower. So if you're really a person that you have a lot of different options, is what really want to emphasize in this. If your struggle after Mark takes your application and talks about, what your financial situation, if your struggle is, I have good credit, make comfortable enough, money, my household does to make a certain payment. But my struggle is I just don't have the down payment and closing costs. This would be an option for you. But it's
Yeah.
also a potential option for you if you're somebody that, you know, y- I've run into a lot of people, a teacher that maybe has been working for 10 years and she's, been saving in her retirement accounts. Maybe he or she came into money from somebody unfortunately passing away and money was left. Like there's all kinds of way people have or don't have money. So in that scenario, hey, I've got the money, I've got the credit. I just want strictly the lowest potential payment I can get in today's market. Then you would be more focused towards that either temporary or permanent rate buy down, right, Mark?
Yeah, you're right. Because 17.5 or 20,000 would pay for a 2-1 buy down, or also would buy your permanent rate down a good bit.
And for clarity on these two, because I know when we talked earlier, these aren't considered grants, right? This is not that 5-year rule on this one, or is it like you have to stay in the house?
Well, the two products we've talked about community partners, which is primary depending on what type of a job you have, and the first time home buyer product. On those two products, it is a 5-year second that's forgiven in 5 years. There's no payments on it, no interest rate. It's just they're encouraging you to stay in the house for 5 years, and then all of it is paid back. Now, the next program we'll talk about in a minute is different. It is a grant.
So we'll talk. So guys, just so you get clarity on that, the purpose of this is to really help people that want to be homeowners that didn't think it was possible. So you should always have a mindset. You're taking out, a 30-year mortgage. So this is not something like to just flip properties. It has to be, should be, your primary residence. This is who they're trying to make homeowners. Doesn't mean down the line you can't rent it out. We're just saying that if you sell the house, within 5 years, you probably will have to owe in a prorated amount, some of that money back, and it would be collected, I would assume, at closing. So if you ran eight,
Well, it'd be part of your payoff, but unless you just live in the house a year, it still makes sense because it's like 20% a year. So if you stayed in it 3 years, you're not handcuffed. They're
right?
not making you stay in the house 5 years, but in 3 years' time, you would have had 3/5 of that given to you. And when you're buying another house, they're going to pay off the first mortgage. The rest of that money will be part of the payoff.
And just from a real estate agent and broker perspective, you probably would not have accumulated enough equity in the house after you're paying realtor fees and, you haven't paid off enough principal at that point where it wouldn't make financial sense unless it was just a crazy market like it was a
Yeah.
couple of years ago where people were going over appraisals and waiving all their contingencies and everything was multiple bid. I think you should focus on, unless it was a financial situation where you had to get out, utilize this property, to hold on to it, to potentially rent it out, to get to a point, 7, 10, 15 years down the line, where it makes enough sense financially to, incur those selling costs that will be a part of it as well. So those are the first two guys. Mark, let's talk about I'm excited about this one, the Workforce Housing Plus, which is 15,000, which is a good amount of money.
Yeah, and this one, you're supposed to be a first-time home buyer with workforce housing. It's 15,000. But the good thing about the workforce housing is it allows higher incomes. You need to be between 80.01 and 120% of AMI. Now, I ran a couple of scenarios today, and if you had I ran them, and we have a calculator where we'll put your income in. But I think a family of three could make 100,000 and still be within the 120. So you got to be between those. If you're at 80, exactly 80 or below, it is the first time homebuyer product. But if you're between 80% and 120, which will get you up there, maybe in the 114 range, that's the workforce housing program. It's a little bit less. It's instead of 17.5, it's 15,000, but that's still an awful lot of money.
It sure is. Are there any careers that are exempt from that?
No,
It's open to everybody.
yeah, it's open to anyone. Only the community one is for specific professions. This one is, very similar to the first time homebuyer product, but allows higher incomes.
Okay. So in
And a
that,
lot of people are going to fall into that.
yeah, so in that scenario, you're talking about, like you said, if it's a family of two, three, four, like you said, as you go up, they allow more for um,
Right.
income. So that's a pretty good chunk of money, like you could make six figures or maybe just a little bit more, a little bit less, which you could get a really nice house for. And again, same type of things that we talked about, how you can use it, rate buy downs or help with closing costs or down payments. So those are three fantastic programs. Mark, talk about why timing is of the essence on these, because I know you talked about once the money is gone, it's gone. What have you seen from this program for the years that you've been working in it? how fast it can go and when it may come back and things like that?
It can go rather fast. They give a certain amount of money to each participating bank. So when that's used up, there may not be any more. Although the last few years they have come back in July, mid-year, and added some more money to the pool, but I wouldn't count on that. Um, when we talk about this program, it's a program that can run out of money. I mean, it's typically 45 days down the road is probably a good guess. So if you're considering this, I mean, the first thing to do, of course, is get pre-approved, but also hopefully you can, make your decision on the right home soon because you reserve the money with a contract. So you can't, I can't register you for this money if you're just out looking. Now I can qualify you for it, and the good thing is we've got this income calculator, which I can just plug in your income, and it'll tell us which program you're in. Um, but it is money that can go pretty quick, as opposed to some other products that we have that don't run out of money.
So let's just talk about this because this is a real conversation, guys. So if you qualify for any one of these three programs, for Great Homes ATL, we have been able to, blessing wise, we've been able to reach people overseas, out of state, and here locally in Greater Atlanta. So, when you're watching our videos, when you're seeing homes that we post, when we talk about pre-approvals and stuff like that, and people ask us all the time, when should I reach out to you? I'm looking to move here in 6 months, right? This may or may not be your program because, like Mark said, the funds may be gone by then. So, you have to kind of weigh a lot of different things. You want to make sure, obviously, you don't move here without things like unemployment, or if you have a house to sell out of state. Those are things to truly, truly consider. But if you have gotten a job offer and you were thinking about, moving here in 90 days, hey, hey, employer, I'm looking to shop for a house. Is it possible I can move that date up? Because there's a good shot that by the time you go under contract, in most cases, you're closing within 30 days, maybe 45 days. But
Hmm.
Ameris Bank and a lot of other lenders, I mean, they can close you because the way Mark is going to collect your data, get you through underwriting. We'll talk about that process and stuff like that. It's really about finding the house, submitting the offer, getting it accepted, and really the only things that you really are having to worry about at that next stage is, do you want to get a private home inspection during your due diligence period and when the appraisal comes back, which tells the lender the value of the house that you put in an offer for. So it goes pretty quick because due diligence periods on the high end, the long end would probably be 10 days. But in most cases, sellers are looking for 3, 5, maybe the most 7 days to get your home inspection done. So you have to look at your scenario. And this is why having these conversations, not only with Mark first, because you got to know these programs and what you can qualify for and what's available to you. But then when Mark sends over the pre-approval to us and, hey, I'm ready to go, you have to be ready to go for this, these three particular programs. Doesn't necessarily guarantee that the money will run out. Nobody could project the future, but when you got these type of programs, trust me, the money's going to go fast. So that's why we're recording this on February 20th to say, hey, this program starts on February 24th, 2025. And, Mark will be monitoring to see, making sure the funds are available at that time. If not, I'm a big believer, Mark. I know you are too, and you've learned this throughout your years too, is have a plan B and have a plan C too, right? So if you got it accepted for this program, great. If you can make it happen. If not, what's the next scenario? Is there grant money available for you? We'll talk about new home communities available for you with rate buydowns and things like that, or other builder incentives. But the key to these three programs, time is of the essence. So kind of
Right.
know you're here in Atlanta, you're moving here in the greater Atlanta area relatively soon. and literally be ready because we will be home shopping really, really quickly. So those are the three programs. Really excited because we haven't seen those type of numbers. I think the most we saw, we had a $12,500 grant program
Right. Up to, yeah.
but these are major numbers: 15, 17,500 and 20,000. One other thing I want to I know the question is, okay, we got income out of the way, Mark and Mark.
Mhm.
Credit. What are we looking for credit for these type of programs?
Well, there's conventional loans and there are FHA loans, and both are good financing. FHA rates are actually a little lower than conventional, but they have more mortgage insurance. So typically, if you have your choice, you would choose a conventional program. Now, FHA will go down to a 620 score. That's kind of the bottom. Conventional, I see more for people probably 680 and above. So we'll help you to determine which one of those two is the best.
And Mark has a while we're here, I guess, because this has actually been coming up lately. Mark has a credit analyzer tool. We also have people in-house that are credit counselors that can help get it up. Um, talk a little bit about, the big fear out there, Mark, about inquiries, right? Everybody hits us up and is like, I don't want to get my credit pulled. I don't want to get my credit pulled, but you're hitting us up because you want a house and you want a mortgage. Let's get the conspiracy theories, the misinformation out there. What happens on your end when you're pulling somebody's credit?
Well, everyone gets a certain amount of inquiries a year without it affecting them. I'm not sure how many it is, but I'm sure it's at least three or four. And, at the beginning of the year like this, chances are people have not had anybody pull their credit, or maybe one or two. When inquiries can affect your credit score is with multiple pulls, and they generally hit you for 4 or 5 points. So it's not like it's going to take you from a 750 to a 680 or anything like that. It might drop it from a 750 to a 740. Keep in mind that a 740 is the top tier for the best rate. So whether you have a 740 or 800 does not matter. You'll get that person will get the same rate. Now, as far as let's say that you've had a few pulls, and you go to a mortgage lender to pull your credit, you've got 11 days from the time the first mortgage lender pulls your credit to shop for a mortgage. So now, some people will hear the term soft pulls. We can do soft pulls, but the problem with soft pulls is you can't run it through the lender's underwriting program. And basically, every lender has the same program. It's an FHA program or conventional. So it kind of handicaps you. A soft pull is just to kind of give you an idea, but it doesn't allow you to be run through the actual approval tool. So for anyone, especially with it being this early in the year, and if you know you haven't had a bunch of people pull your credit, you should always do a hard pull, because then the lender can give you a solid pre-approval, which we work with you to become an approval. But at least you'll know, like if we talk one day and you know your income and all that stuff, I'm going to be able to tell you pretty quick, look, as long as this stuff checks out, you're good to 450,000 or whatever it is. So you know that. And then what we do to get you fully approved is we just get some documents from you, like pay stubs and W-2s, bank statements, and we submit it to an underwriter. And if it comes out of there approved, you're generally only going to need an appraisal. And that's very valuable, because if you're in a multiple bid situation on a house, it's going to mean a lot that your loan is approved, not pre-approved.
I think Mark too, we've discussed having a policy or from the relationship between the real estate agent and the lender that you're even willing to call the listing agent or the on-site agent if it's a new home build and like communicate to them, hey, I have them through automated approval. All we need is the appraisal. And that's pretty powerful, right, Mark?
Yeah,
Coming
I'm going to do that on every client. I mean, if you tell me you're about to submit an offer, I'm going to call the agent on the other end and say, look, you need to take my client's offer because they are approved through underwriting. All we need is an appraisal, and that can really help you to get a home that maybe has several bids where you normally wouldn't. Because the seller's gonna really like that they don't have to worry at all about you closing on the home.
Absolutely. It's very powerful for us on the broker agent side. It provides really goodwill with the seller and the listing agent. Everybody can feel confident about it. Like I said, it's just about getting your inspection. If something came up during the inspection and we can't make it work, we can't negotiate what the seller's going to fix, then you get your earnest money back, which we talked about earlier, and we go on to the next property. If it's
Sure.
acceptable terms during that due diligence period and the seller's willing to fix some things, you kind of know you have the money and you have the clarity of what you need to do to the property, especially if it's a resale home. New homes, you have a warranty, so you're pretty much protected. It just makes, as you can see, guys, hopefully you're learning from this, is it really all starts with having the conversation with Mark and finding out about these programs, finding out what your credit score is, talking about and sharing your household and your finances. Then it really becomes a very, very efficient and fun process because we all know our numbers. We feel really strong with every offer that we're putting in, and you should have nothing to be fearful of. I will say, and Mark, you could talk about this too. Sometimes people get confused with a pre-approval and conditional approval, and we've dealt with this over the years since we've been in business together. Um, if you got a pre-approval or conditional approval, that doesn't mean stop paying your bills. That doesn't mean take out new loans. That doesn't mean keep applying for the Macy's credit card or the Target credit card because they are monitoring your credit, right, Mark?
Yeah, and this is not just Ameris. I think it's true of all lenders. They'll do a soft pull, which it doesn't affect your inquiries, but they'll do a soft pull close to closing. Just to make sure that you haven't added a lot of other debt that could influence the approval. So just be aware of that. Um, it's not a good idea to take out an installment loan or anything of that sort during the process after you've been approved. And I would also point out a few things like if a client is looking to move to Atlanta and purchase a home, let's say it's even 6 months down the road, we can help you. We can get you approved ahead of time, but the only situation where I would not recommend doing a pre-approval is if you don't have employment in Atlanta or you're not a remote employee. If you're thinking of moving from New York to Atlanta, you do need to secure the job because we have nothing we can go off of. We can't use your New York income unless your company verifies that you're a remote employee, meaning that you can live anywhere you want and work out of your home. That's okay. But occasionally I get calls from folks that they want to move to Atlanta. They haven't secured a job. We can't really give you a solid pre-approval or approval not knowing what that job is going to be.
That makes sense. I'll give you guys a couple examples. So, obviously, during the height of COVID, there was a lot of people working from home. A lot of people still work from home, but a lot of people obviously are starting to go back into the office. But if you do have that job that is keeping you working from home, we had a lot. I mean, I talked a lot of people from California, New York, Chicago, Philadelphia, Connecticut that worked for a healthcare company, a tech company, wherever, whatever the company was, and they simply needed verification from HR on a letterhead saying Cindy is able to, we understand she will be working from Atlanta, Georgia, or Sandy Springs, Georgia, or Cumming, Georgia, wherever it is, and in the state of Georgia, and she will be making this amount of money and she could do this at any time. That's enough. And then probably through the loan processor, Mark, right, and underwriting, they'll call to verify employment and things like that. But having a letterhead, Mark could kind of walk you through that. You might even have a template to form, to show them as an example for that scenario. Another scenario that has happened recently is I spoke to somebody that's a nurse in the um, New Jersey, New York area. Um, and she has pretty much like three really solid interviews already. And they're basically saying, just tell us, which one you want. We have offices in Dallas, Georgia. We have offices in Sandy Springs. We have offices in McDonough. I think she wants to be more in that Dallas area. So in that scenario, again, you should have the conversation with Mark, but just understand he could kind of give you ideas of he'll gather that information. So if you're a nurse and you're making $80,000 and in this scenario you have nobody else in your household, you're just a single male or female, and Mark verifies all that, and now you qualify for one of these programs because you fell into that bucket. Or let's talk about the 60,200, right? For that 80% rule for that program. Um, he's not going to run it through underwriting at that time because he'll need from you the actual, right, Mark, job offer letter.
Yeah. I mean, I can run some rough numbers just to give you based on the income you think you're going to get. I can't get you an approval, but my experience, particularly for nurses, is it's pretty easy to get a job if you're an RN. So, I can run rough numbers for you, but at the point where you accept that job, I mean, typically you need to be on the job for 30 days. In some cases, they may do 2 weeks, but in a lot of financing, it's 30 days. So, if you can get a temporary place to stay down here or stay with family, start the job, we can close you 30 days later.
That's pretty much the scenario we talked to her about. So keep that guys in mind. If you do have family, you might want to stay with them for 30 days. Worst case scenario, if you have to stay at a short-term housing, a
Sure.
resident inn, an Airbnb, whatever the case may be, just know that it's worth it, especially if you get help with down payment assistance programs, and just knowing where you're going to live. Again, then once you got the job and they're gonna you got that letter to Mark and this is how much you're going to make, he could start running things through. And then it's just verifying, when you get that pay stub number one, pay stub number two, if you get paid every 2 weeks, boom, we could close, after that. So that's that process. If you don't
One
want,
more thing, though. Now, if you're with a company and they transfer you to the Atlanta location, you're okay. They just want you to be here, but you don't have to wait 30 days. If you're working for a company and they say, "Look, we're transferring him to Atlanta for this rate of pay," we can get you approved.
so in that scenario, Mark, let's say it's somebody that's working at Home Depot, the actual store, right, in Philadelphia, and they're transferring them to the Home Depot in Smyrna, Georgia. That's fine because it's within the same company, right?
Yeah, yeah. They'll verify that you were actually here. I mean, they can't write a letter and say we're transferring you next year. But, if they say, okay, you're going to start March 15th, that's fine.
Okay. So see, guys, there's these different scenarios again, why it's important to talk these things through. Mark, let's talk about. I'm kind of excited about it. Even if you don't qualify for these programs, you make too much money. Let's talk about the other grant programs that Ameris has. I think you have a $3,000 one, and is it 6,000 for the other one?
Yeah, there's 3, 6, and 7,500, and these are ongoing programs that don't typically run out of money. Now, but we had a little change of that earlier this year, where it used to be 12,500, now it's 7,500 or 6,000 or 3,000. But those programs are not as urgent. We anticipate that we'll have them all year, maybe longer. So,
Let's
what I
start
would
with
probably do.
Can we start with the 7,500 and work our way down? So, do you have some parameters of what that 7,500 program is?
Yeah, the 7,500 is an HEE program, Housing and Equity. Can't remember the other E, but that's a conventional loan. So you typically are going to want to have, a 680 or higher for that. It's 3% down, but it's up to 4% of the sales price. So you're probably going to get the full 7,500. Um, there's that program. Now, that program is dependent on where you live now. So it's certain MSAs, but I look at it primarily at census tracts in Georgia. If you're renting or staying with family or whatever, we can establish that really quick. It's minority census tracts. If you're in it, you're eligible for that program. So that's the HEE program, which is up to 7,500. There's also the Ameris Down Payment Assistance Program, which is 6,000, and that one is just got income caps. They're higher than these other programs with FHLB. They're typically in the 80s, even if it's one person or two persons. These programs are also different in the fact that they only count income from who's on the loan. So it's not household income, which, you might, let's say that one person made 80 something thousand. And the other person made 80,000. Well, if you could qualify on one person, I had one like this just a few weeks ago where the person had income around 80,000, but they also received VA money. Well, that program allows us to not count all the income. In other words, I did it and I said, let's just use your income, which made the person eligible for down payment assistance. She qualified without the VA income, but that was a way where a person that on one of these other programs it would have been a problem, we were able to get this person 6,000 in down payment assistance.
And is that so that the 6,000 one is not area specific?
No.
Okay. So there are some really,
Well, it's
really
in the Ameris footprint, but that's really the full 5 county area. It may not work if you're buying in some rural area, but
let's talk about that. I mean, how this could really in the real life, and I think we have a couple examples over the last year when we did the 12,500 and now 7,500, which is still good money because what I love about that program is we had a scenario where um, I'll give you two quick scenarios. So we had somebody that was grew up in Atlanta, was renting at or I think they were actually staying with their family in Stockbridge, Georgia, and was in the medical profession, but wasn't like a licensed doctor or anything like that that can qualify, which we'll talk about the medical professional one. Um, but wanted to be closer to the interstate on the northwest side because he was working, I think, off of 285, like that Dunwoody, Sand
Mhm.
Springs area. And I sent him, like I do, to Mark and his wife, who also is in the mortgage industry with Ameris, and we got him to 12,500. And typically, like I said, a lot of the down payment assistance programs, there are, as you saw for the Federal Home Loan Bank one, there's a lot of stipulations and stuff. What I loved about that program and what I still love about the 7,500 one is there's really now like income caps on that. So if you're making really good money, if you're making 90,000 or you're making 225,000 and you are staying with family and friends or renting in one of these minority demographic areas, which is pretty broad in greater Atlanta. Like I said, Stockbridge, not a bad area. We're from Douglas County, Douglasville. There's a lot of parts of Paulding,
Mhm.
south of the city, and there's even little pockets that
Yes, there are.
Mark has been surprised when he's pulled it because he'll plug in your address. But there's a strategy, and he got the 12,500. In this case, you would get the 7,500. So money wasn't a problem for him. He was a good steward of his credit. He had been staying with his family, so he was able to sock away a lot of money. Well, that money came in big time handy because it was less money he had to put down. So now he could do projects to the house or pay for movers or buy furniture and things like that. And so I love that program because there's a strategy to it. If you are relocating to Atlanta, you've been following Great Homes ATL, and you're relocating from a pretty expensive city like LA or New York or Chicago, and you're making good money, but you're not super familiar with the area, and you want to spend some time kind of familiarizing yourself. A good strategy, Mark, I think, would be, okay, that's rent in one of those, what we used to call it, because it was highlighted in a gray map area. But Mark will be able to kind of tell you, okay, what apartment complexes are you looking at? What Airbnbs? Because it doesn't have to be long-term housing. I think you just need what, a utility bill or something like that, Mark.
Yeah, it's just proof that you live there, even if it was just for a month.
Yeah, so there's a strategy to it to say, okay, I'm going to, stay at the Airbnb or with a family member, or do a 3 or 6 month rental until I really feel confident in the area. The great thing about that program is you just, rent in that area, and there's no limits to where you could purchase it. So you're staying, say, like in Fairburn, Georgia or Douglasville, Georgia, but you really want to live in Marietta or Cumming or Sandy Springs or Buckhead, you could strategically utilize this program, for that 7,500, which I think is pretty cool, right, Mark?
Yeah, it's dependent on where you're at now, but not where you're buying. If you're eligible for it based on where you're at now, you can buy anywhere. And I think the key takeaway, because there's a lot of these programs, and for a home buyer, they probably can't keep up with all these rules.
Right.
So the first thing you look at is the majority of these programs are for people that are first-time home buyers or have not owned a home in the last 3 years. I mean, there's the workforce housing and the communities that you can have owned a home as long as you're buying a primary residence. But most of the down payment assistance programs, that's kind of unique. Most of the down payment assistance programs want to make sure you haven't owned a home in 3 years. And then, if you talk to me, and probably the earlier the better. I mean, if you're looking 2 years from now, it's not necessary. But if you're within 6 8 months of buying a house, it's a good time to talk to the loan officer, because we can pull your credit if you've got concerns. That gives us time for us to run a report and say, if you do these four things, your score will be 750. It gives you time. Sometimes if you wait until the last minute and you get a surprise on your credit score, like somebody put a couple of collections. I had somebody in January like that who swore to me they had an 800 score. And I think they normally did, but somebody hit them in January right before, and he held me off on pulling the credit for 2 months, and because he was worried about inquiries. So when we pulled it, sure enough, two companies that put small collections, and it dropped his score 100 points. So it's a good idea, if you're looking on down the road, to have your credit pulled and get pre-approved, because if you're a first-time home buyer, I'm going to look at all of the programs. The ones that we have that are conventional are stackable with the Federal Home Loan Bank, meaning that as long as you fit the guidelines for both programs, you may get the 7,500 and the 17.5. They can
Wow.
be used together. A lot of programs are not like that, but FHLB allows that. So if you can meet their guidelines and you meet our guidelines for down payment assistance, you can get both.
Yeah, I think that this is I like that you said too, like they're stackable too, because they're two separate programs, two separate banks. And the Ameris one is a grant based. So when we talked about that 5 years, the second
Hmm.
mortgage at 0%, it's the same type of scenario. But being able to stack these are really, really impressive. Just the last two before I get into new construction, because the whole point of this one is obviously to make you aware of Mark Scarratt and Ameris Bank and feel good about the process and not worried about these inquiries and stuff like that. Um, but also to have you come out of pocket as least possible as you can. So the last two I want to talk about, Mark, are medical professional and VA. So talk a little bit about the medical professional because I thought this was cool about all the different professions that it covered. It's a no PMI, no money down because they're taking into consideration these fields. You probably have taken out quite a bit of student loans and stuff like that. So talk a little bit about some of the professions, which I think will surprise you, and what that process looks like.
Well, that these programs are geared towards newer doctors or medical professionals. If you've been a doctor for 20 years, they're going to expect you to have the down payment and go with a regular program. So it's generally, out of residency within 10 years. And they're trying to help people in this profession who maybe have not had time to save their down payment. That's what they're for. And they do go to 100%. They have no PMI. So it's geared towards, a new medical professional. Ours is a little expanded. Many of the banks are solid on an MD. Ours allow podiatrists, they allow chiropractors, they allow a lot of the medical profession that other banks do not.
Yeah,
So,
I'm just going to name a few more because I have the flyer pulled up just so
mhm,
you guys could know. And these are loans up to $1.5 million,
right.
because probably people in these professions are looking in for, pretty close to hospitals and more expensive areas. But just to name some of these, and it has to be a primary resident, so it can't, you have to show proof of residence and stuff like that in Georgia. Um, it's available to residents, fellows, medical doctors, osteopaths. I don't think I've dealt with one of those yet.
I'm not sure what that
Uh,
is.
Dentists, pharmacists, really cool because we're pet lovers, veterinarians, physician assistants. What would
Yeah,
that?
PAs. Yeah, PAs. And most banks don't allow PAs, and they certainly don't allow chiropractors.
Chiropractors, podiatrists, so all the foot lovers
Hmm.
out there. Maxillofacial surgeons. Is that like plastic surgery or something? Is that
That one I'm not sure of.
ophthalmologists
Yeah,
and
an ophthalmologist would be a good example.
yeah, so that's quite a bit of options for you. And again, it's really steered towards, and then we get this a lot. Does that include nurses? Does that include traveling nurses? It doesn't. But there's other programs, there's other things like we just talked about that could potentially, get you lower down payments or grant monies, as we were talking about the Ameris grant program and the first time home buyers and the federal home loan ones as well. So that was
And one thing too to point out is even if you're not eligible for one of those programs, there's a good chance you're qualified for Home Ready, which is a conventional program. It's not down payment assistance, but you can put 3% down and you get a lower interest rate and lower PMI if you're a first time home buyer. So for the most part, at the very least, you'll probably get on that program, which just gets you a little bit better interest rate and lower PMI.
I love it. I love it. Yeah, we definitely had. I remember our guy Tyran and his wife. They bought a lake house in Douglasville with us, and his wife was a doctor with Morehouse, and he just he was a vet too, so he could have used his VA, but this program was just as good because they did have um, some debts and stuff like that, and they had previously had another house that they were going to hold on to that he already used his VA loan. So,
Yeah,
um, but I think I saw on his social media, or no, he texted me. He had, I think, made his last payment. He has done amazing with stock trading now, and is actually teaching a bunch of veterans. And I think they paid off their house, and now it's like worth about 25-30% more than what they bought it for. So just
yeah,
go.
he was a great guy. I went out to his place. He's got a beautiful place on a lake. I mean,
Yeah, we gotta make another trip out there this summer. I think it'll be a see what he's done to the place. I think he's raising chickens and
oh wow.
stuff. So yeah, so that's again example of one person in the household was a veteran, another person was a doctor, and then trying to find out based on debt to income ratios. They had already used their VA loan. They wanted to hold on to that house, so they couldn't use it again. These are all scenarios of why it's super important not to literally fall for the okey doke with all these ads that pop up or on Zillow and Rocket Mortgage and Lending Tree to just type in your information because as you see, this is a lot of information, a lot of different programs that they are just not people just are not aware of. Um, and then finally, let's talk about the VA loan because we have a lot of veterans that follow us. Many people that have been on military bases watching my videos and home tours and things like that, and come over here and buy a house. So, Mark, talk about that because that's another no money down, no PMI program.
Yeah, it's VA is probably the best financing you can get if you're looking to make no down payment or a small down payment. And VA is available to veterans. I believe you have to have 2 years of active duty, or you can be in the National Guard, but I want to say it's 4 or 5 years. But you'll know because you'll get a certificate of eligibility. Now, VA has funding fees. It's if you're a first time use of it, it's around 2.15%, which is financed back into the loan. If you use it for a second time, it's 3.3. But many people that are veterans have some type of disability. If you're receiving any money, even if it's $300 a month from the VA for disability, the funding fees are waived. So you have nothing. I mean, it's just 100% loan. The rates are good on them. It's a little easier to qualify for VA loans, so it's wonderful financing. So just make sure you've got your benefit, which should be pretty easy. You can talk to your commanding officer, but you've probably been issued or told you have the benefit. So VA will go 100%. You can actually use it a second time. We just have to calculate what they call partial eligibility. So you can have another house, buy another one VA, but you likely won't be able to go 100%. You may have to put 10% down or a certain amount down, depending on how much of a loan you got on that first house. But in some cases, if you've got a little down payment money, you can use your VA twice. And if you are receiving a disability, both loans will not have the funding fee.
Oh wow, okay. That's great. And sometimes the funding fee could be rolled into the mortgage.
There, it's almost always rolled in. I mean, it's rarely have I seen somebody actually pay it. I mean, you could have the seller pay it, but they would have to pay all of it, or you could pay it. But I'm telling you, 99 times out of 100, you just finance it into loan. So you don't put anything down. If you've got a 2.15, it's just financed back into the loan. The property doesn't have to appraise for that extra amount.
And
It
this
just has to appraise for the 100%.
this is really come in handy again. The VA loan, in most cases, like Mark said, no money out of pocket, no private mortgage insurance, which saves you, some cases, a couple $100 easily. And then a lot of times in Georgia too, a lot of counties for property taxes, if you are disabled, you're saving quite,
That's right.
quite a bit. Quite a bit. So we have helped literally dozens and dozens and done a lot with Mark, and he's working with a couple of our clients right now. We have clients that are relocating, I think, from Florida, um, and
A couple from New York.
New York too, yeah, and another one from Connecticut or Virginia. So, um, what would you say, Mark? So the scenario is on that, like, say somebody's in the Navy, right? And they're retiring, they plan on retire in 6 months, and the wife has, she is going to be, handling kind of the home shopping and, while he's on the naval ship or if he's overseas or whatever the case may be. What would you need in that scenario? Just the letter from the military that this is his date or her date from retiring from the military, and then what the money will be, what their pension or whatever I guess the income that they get after they
Yeah.
retire?
Now, a couple of things about VA. The only acceptable co-borrowers on it are a spouse or another veteran. So if you can go VA if you, let's say your brother signs with you, but they will calculate partial eligibility. So you probably will have to make a small down payment if it's not your spouse or another veteran.
Mhm.
Now, you can, let's say that the wife or the husband is the veteran and they're stationed out in Colorado. As long as the other person on the loan will occupy the house, you're okay.
Okay.
Let's say if one veteran was buying the house and they're stationed in Colorado, you can't do it unless you've got something saying they're going to be transferred here. I think they have to be in the house. Um, I think it's up to 6 months. So they have to have something in writing saying, okay, they're going to be back in Georgia. It has to be within 6 months of the closing of the house. I learned some of this stuff because we had a client like that. Um, but VA, you can get, you get your LES, which is your leave and earning statement, and oftentimes they receive non-taxed income, which we can gross up 25%. So there's a lot of tricks with VA that may not necessarily work on other types of financing.
Wow. That's really good. So I think we ran down pretty much all the low to no money down and a ton of down payment assistance programs. And I want to stress, guys, again, relationships in real estate, the lender, the agent slash broker in our case, and owners of our own firm, relationships with private home inspectors and closing attorneys. These are all things and in order that you really need to go. So if you've been following us, if you're watching this on any of our platforms, again, our website, social media, any platform that you're watching, it really begins by going to GreatHomesATL.com, hitting the begin pre-approval or get pre-approved buttons. If you just want to have a consultation, we have those as well. But as you can tell, like Mark said, if you're probably, one last thing I want to touch upon before we leave too, which is new construction and Mark's relationships with some builders and new construction and how that can help. Um, the whole key, guys, if you think you want to move to the greater Atlanta area, you could see the different strategies we talked about, the different income levels, some programs where there are no income limits, like the 75 $100 program, very large limits on that medical professional one, very large limits. I don't even know if they have limits anymore. Mark, do you know on VA? I don't even think there are VA.
VA is yeah, it's interesting. You can go in some cases. There's a calculator, but they don't really have a max loan amount up to a certain point. I remember doing a calculation for a veteran that had never used it, and it was up like 900 and something thousand that
Yeah,
he could
so
go. So yeah, VA is a
pretty high.
very powerful tool
Yeah.
and really good financing. And and I would add that when you talk to a loan officer, if they're just telling you what you need to do without giving you a reason, then they may not be doing the job. Sometimes loan officers will stick people on FHA because they're easier loans. Yeah,
Right.
well, no, I don't put people on FHA if they're eligible for conventional. So when a loan officer tells you, I recommend you go conventional, they need to tell you why. Or if they tell you to go FHA, they need to tell you why, not just you need to go FHA.
Yeah, no, that's a really good point. That's why we really love working with Marcus because he's not trying to do anything underhand. There's a lot of slimy people in real estate. Trust me, I've been licensed since 2003 and now owner of my own company and get approached by all different lenders. I love working with Mark because he has morals, ethics, and is going to do what's best and make sure, hmm, th this could be a program for them, but hey, there might be something better, or There may be even a program where there is down payment assistance, but you'd be better off doing this other route because, you qualify for the medical professional or the VA or another program that we have. So you're going to be in really good hands, and it all starts by doing that. Finally, I just want to say too, what I love about Ameris Bank, they have great relationships too with a lot of new home builders in the area as well. It's quite an extensive list that Mark sent me, and we'll have that for once you're one of our clients, and we could go down that list if you want to keep the loan with Mark and make sure, hey, he's been great to work with. Now let's just go find the builder in that situation that has these programs. And what happens a lot now, currently in February of 2025, at least, is because we are in a higher rate environment. A lot of builders are on their standing inventory. They have what is it called, Mark? A builder fund where outside of their contributions, they have a bucket of money to help buy down people's interest rates.
Yeah, it's a forward commitment, and you're typically going to see that with very large builders, not as much with small builders, but D.R. Horton, companies like that that are national, and they'll put a certain amount of money with a bank, and they can use that money on individual houses or whole subdivisions where they may buy your rate down to 4.99. And if I've pre-approved you and you decide you want to buy with them, I'm certainly not going to hold you back. I mean, I'm going to tell you, we're not approved with them, but you need to go with their lender because you're getting an extraordinary deal if you do go with them.
But yeah, but you do have quite a extensive list of builders that you sent over. So we would, if you really enjoy, working with Mark, and maybe you qualify for one of these programs and you're like, yep, that's my guy either way, then, and news the way you want to go, then we'll have this list of builders and we could co-examine that. A lot of times they are also contributing one builder. We've had a lot of success with. They give about $20,000
Right.
in builder incentives, and I think it's about $1,500 if you're a veteran. So potentially you could get 21,500 in that scenario. Plus, Ameris has, as their preferred lender, agreed to give 2% credit as well. So in a lot of cases, we've had veterans move up. I think we had a couple from Albany, Georgia, and Pooler, Georgia, and all different parts of Greater Atlanta, and even out of state, that moved here and built with this builder, and they have very, very little to bring to the closing table because at 20,000. That's going to cover a big, big chunk of your closing costs and escrows, and then deciding again how you want to use it. If you already have the money and you want to throw a bunch at it for that rate buy down, Mark will work through all those scenarios for you. So I just wanted you guys, again, because the purpose of this presentation, this education tonight, is to get you to the closing table with as little when it's possible, if that's your scenario, especially a lot of first time home buyers, medical professionals, and veterans. um, it's really becoming much more feasible because of these programs. So I hope you guys found this really educational. When you go to GreatHomesATL.com, again, you will have all Mark's information when you hit get pre-approved. An email goes out to him, it goes out to us. And again, you guys can schedule a time to talk about all these things. Don't be stressed on it because Mark really makes it, knows how to talk to you and knows how to make you feel comfortable. It's really just making sure you're prepared. Make sure you know, again, in these scenarios, truly do not lie to the lender. Do not, just be very honest because how many people are in your household? What is your income? What are your bonuses? All these important questions because again, if one program doesn't work for you, don't worry about it. There are going to be various other ways to go to help get you to the closing table.
Well, everybody is going, what you're not going to hear from me is, look, you can't get a loan. See you later.
Right.
Even if let's say you can't qualify now, we're going to talk about what it's going to take to qualify you. We can run a credit scenario that will tell you specifically what you need to pay down to get to a score. Or, if you need to get a job here and you're in another state, we'll talk about those things. It's not just going to be, you don't fit our guidelines, call us back when you can. You're never going to get that from me.
Yeah, we do a really good job with our system too and follow-ups. And I know I've seen a lot of emails go out from Mark, 3 months, 6 months down the road, and people do come back. So it's just about putting a plan into place, and we definitely have the various consultations for you. So thanks so much, Mark, for really explaining
Yeah,
that.
really enjoyed it.
And we'll talk to you guys soon.
All right, take care.
All right, take